Hello to everyone listening to our podcast, The Active Investor with SGH. I'm Steve Hiscock, the chair of the company, and it is my pleasure to be your host again for today's episode. In today's podcast, we'll be looking at what happened over June 2025, and we'll be discussing the outlook going forward. This podcast is being recorded on Wednesday, the 2nd of July 2025, and joining me again today is our Chief Investment Officer, Rob Hogg. Hi, Rob. Welcome back again.
Thanks, Steve. Great to be back, as always. Thank you.
So, Rob, again, June was a busy month for news. The US struck 3 nuclear sites in Iran. Iran struck back. The oil price rose strongly and then fell back. US hard data is starting to show signs of a slowing US economy, but the Fed still did not cut rates. And then Trump naturally stepped up his attack on the Fed chair. And so I guess from most people's viewpoints, it would have been reasonable for investors to have expected far greater market turbulence in June. Oil, obviously, the oil price being the exception, but that really wasn't the case, was it? In fact, equity markets rallied. So can you give us your summary of what happened in June and why?
I think, actually, as you're just saying that, the word that we used last month, you might remember, but that you sprung on me, maybe it's a case again of investors just becoming more and more attuned or used to this sort of volatility, because certainly some of the events we saw during the month, you would really have expected there to be significantly more volatility and in fact market weakness. But really, apart from the oil price, which rose quite sharply around mid-month, but then it gave away a lot of those gains by the end of the month as a ceasefire seemed to be in place and working, as the likelihood of trade deals between the US and both the EU and China seemed to be more likely, as the Canadians who'd called for a global digital tax then cancelled that call at the very end of the month. The pending passage of Trump's big beautiful tax bill, which has subsequently gone through the Senate, and that will go back to the House. We'll talk about that in a little bit. And then talk as well that the US administration might delete Section 899 from its budget legislation. So all of those sorts of elements seemed by the end of the month to leave the market in a more optimistic sense than they were at the start of the month, despite everything that happened from a geopolitical point of view and all of the ongoing turbulence and uncertainty we have from this US administration.
So what were the key market moves?
Well, look, here in Australia, the market moves are relatively muted. The broader equity market returned almost 1.5%, but that was really left in the shadows by the US. So the S&P rose around 5% for the month. And similarly in interest rate markets, our markets didn't really move terribly much at all at either end of the yield curve, whereas US yields did move quite a deal, indeed more than twice as much as ours. And that was really in reflection of the fact that US investors are now expecting a higher probability that the US central bank will be cutting rates, and sooner than they had thought at the beginning of June. Whereas here in Australia, whilst the market moved to a more than certain expectation of a rate cut next week, that wasn't hugely different from where our market expectations started the month of June. So it was really about, in the US, a change in monetary policy expectations. I think that was responsible for what happened with rates there. And for equities, it was really the ceasefire, the passage of the bill, and some signs that some of these trade negotiations will come to a fruitful end ahead of the July 9 date that Trump has set for this to occur.
So in summary, oddly enough, market sentiment improved. Is that right?
Yeah. Well, if we just look at the level of equity markets, yes, it did over the course of the month. And it also wasn't that incredibly turbulent during the month. So even as the US fired on those nuclear sites, even as the Israeli-Iranian hostilities began, we just didn't see huge downward moves in equities or huge downward moves in bond yields, or for that matter, a huge upward increase in the US dollar. And the US dollar itself ended the month a bit lower. So it's really quite an interesting set of market reactions to what's been going on.
And is it fair to say that the market's becoming a little bit more comfortable on the tariff side?
Yeah, look, there are a number of issues here that I've been worried about. One is the disruption of tariffs on sentiment, spending and investment. And look, we haven't seen a huge lot of signals that that's occurring. Yes, some of the so-called hard data is slowing, particularly in the labour market. And look, perhaps this Thursday night when the next report comes out, we may get some payback for that. But so far, employment growth is continuing, albeit at a slower pace. We haven't really seen the inflation impact either. So far, there's really no sign that inflation's picked up, even in its broadest sense, across the US economy. So that as well, I think, was a positive for the month, that some of the negative impacts from tariffs on spending or inflation haven't really come through either.
So, Rob, one of the things you've been talking about in a couple of reports is your discussion about the changing nature of portfolio flows into the US and how you see that affecting things. Can you just talk about that?
Yeah, a couple of months ago, I came across some research from Citibank, or Citi as they're now called, I beg your pardon, and they'd done some analysis looking at the nature of the inflows into the US. So the US runs a current account deficit, and that needs to be financed by foreign investors. This basically means that they spend and invest more than they save. Now, traditionally, a lot of the inflows in terms of portfolio flows into the US had been into US Treasuries, so into government bonds. But that has really changed in the last 5, 6, 7 years, such that foreign ownership of US equities has increased significantly, and that's taken on a much more important role in financing the current account deficit. And indeed, post-pandemic, the US is now an importer of equity capital. So what does all that mean? Well, what the implication of that could be is that obviously equities are a risky asset class relative to bonds that are usually defensive, not always, but usually. So when we've had big market drawdowns globally, so equity market falls, the US dollar has often acted as a safe haven. And one of the reasons for that may have been that treasury bonds, which were what offshore investors owned, would often rally and rise in value. Whereas now we're in a situation where market sell-offs with equity markets potentially see investors flee the US and flee the US dollar as a consequence. So it's the underlying nature of these portfolio flows and how they interact with market drawdowns that may be causing the change in the nature of the US dollar from being a safe haven now to being, in fact, a risk-on, risk-off type currency, more so like the Aussie. But for Aussie investors, if this pattern continues, it's got some pretty significant implications for the hedging of global equity exposures and perhaps the sort of counter-trend nature of the Aussie dollar to global drawdowns in equities might be changing. And that's certainly what we saw and have seen during the course of this year. The Aussie has generally risen during the month of June, even with all of this turbulence. So there's some real questions about US dollar and whether it's a safe haven anymore.
Yeah, and that's right. I mean, the other question is whether it's cyclical or structural, and how long that takes, and whether we're seeing as we've discussed a couple of times before, Rob, whether we're seeing the end of this, as you were talking about, as the safe haven.
Well, that's right. I think this is also wrapped up with this whole US exceptionalism story. So US equities had a very strong run into the end of last year. European equities and Asian equities had a very poor run. This year has been the opposite of that, broadly speaking, although not in June, interestingly enough. European markets were weaker as a rule. So I imagine a lot of global investors that have moved out of the US into Europe may now be wondering, is indeed this whole IT, AI story over? Should we be rethinking about the US? Is it still perhaps exceptional, even though we've gone through a 6-month period of wondering indeed whether it was exceptional? So we'll only see this in the fullness of time.
Yeah, exactly. Look, the other thing, and you mentioned it right at the start, that is all over the news at the moment is the big, beautiful bill, which was passed through the Senate last night. Can you talk about that, what the implications are?
Yeah, look, as with most things in the US, this is highly political, to put it bluntly. And look, the votes so far on passing this bill have been really down to one vote either way. So earlier in the month, the bill passed the House, then went to the Senate, and then just last night it's gone through the Senate, but that was only because Vice President Vance voted in a tie-breaking vote. So it's now gone through the Senate with some slight adjustments, so it'll have to go back to the House and they only passed it by one vote. So it's still by no means a done thing. But interesting are the assessments by investors about what the whole bill in its entirety will mean. So, for example, the Council of Economic Advisors, now they are a branch of the Executive Office of the President, so they are sort of White House appointed and on the side of the President. They've got some very different estimates for the impact of the budget and tax bill. And in large part that boils down to their GDP estimates. They're assuming average growth of 3% in GDP over the next 10 years. And as a consequence, they're much more positive about the stimulatory potential impact of the cuts in taxes, deregulation and so on. Whereas if you look at what the Congressional Budget Office is estimating, the CBO, Congressional Budget Office, are really an independent body that work in support of the Congress. They have a completely different scenario. They're not assuming growth to be anywhere near as strong. And what we tend to see in the press is related more so to the CBO, the Independent Congressional Budget Office estimates. And that's probably fair because they are indeed independent. But if we look at their estimates, there's a significant increase in the size of the budget deficit over the next 10 years. But any way you cut it, it's all about cuts, things like cuts to healthcare spending, including Medicaid. So that's the government insurance program for low-income Americans. It's all about a continuation of tax cuts that were initiated in the previous Trump administration back in 2017. And it's all about increased spending on defence and border security, for example, and reduced subsidies for renewable energy. So that's really the nature of the breadth of the bill, but its overall impact really depends on your estimate of what it's going to do to longer term GDP on a year-to-year basis. If you're more optimistic, like the in-house Council of Economic Advisors, they see an overall positive impact, whereas if you're less optimistic, as the CBO are with their estimates, it'll have quite the opposite effect. And this needs to all be seen as well in the context of what is already a pretty serious budget deficit in the United States at a time when the unemployment rate is low, at a time when economic growth is ongoing, and that's not really part of the cycle where you'd expect to have the very large budget deficits that the US government is already running. So where do we look for a sense of how this is all panning out? Again, we look to the bond market. Interestingly enough, with the passing of the bill last night through the Senate, there was very little move in the Treasury bond market at all. So on balance, they were reasonably sanguine, bond market participants last night.
Yeah. No wonder it's political though, right? So, I mean, and no wonder it's so close. You can imagine the Democrats, all voting against this thing, particularly with the healthcare spending cuts. Rob, let's go back to central bank rates. So the Fed didn't cut. The Bank of England also didn't cut. So what is going on there?
Well, look, both of these central banks, they almost had, not quite, but almost had interchangeable statements after their policy rates were left unchanged. And it's all about uncertainty. And it's all about wanting to maintain, if you like, optionality to potentially cut rates, because that's still the direction they're moving in, to potentially cut rates at coming meetings. So in the US in particular, it was no surprise, as we've said, they weren't expected to cut rates, and they're still not really expected to cut rates at the end of July, which will be their next meeting. But that probability is moving and shifting. There are more and more of the Fed, both voting and non-voting members of the Monetary Policy Committee, talking about their own views about what the Fed could and should do. And there are definitely a number of doves, as we describe them, that are talking about rate cuts. We've of course got the President berating the Chairman of the Fed and talking about bringing forward when Trump might announce who the next Fed Chair may be. It's not due until around the middle of next year. And in fact, only today we've got the Fed Chair himself being a little more equivocal about his outlook for the end of July. But presently, there's not a lot priced in terms of expectations. But if we were to get a very weak employment number, for example, on Thursday night, or if we were to see that other broader real economic data, the hard data, if the pace of slowing picked up, we could see a change in those rate cut expectations in the US. And that could occur actually quite quickly.
Right. So that's more likely to happen this month. I mean, Rob, something you've been talking about over the past few months is the divergence between the soft data in the US and the hard data, the actual data that reports actual things happening rather than expectations. But they seem to be converging. But it's the hard data that's starting to soften rather than soft data hardening.
What we've seen is that soft data, survey data, household confidence, corporate confidence, really fell away incredibly sharply about 3 or 4 months ago and reached, in some cases, multi-year lows. We've seen just in the last couple of days a bit of a pickup in some of those levels, but they were probably at extreme and unsustainably extreme levels. They've bounced back a little, but as you say, there's a convergence that seems to be occurring. The harder data, and we're looking here mainly at the employment data, initial jobless claims and things along those lines, and spending as well. They are just starting to lose a little bit of momentum. So yes, they are converging. Partly the softer stuff is bouncing back a little, but also the hard stuff, the real actual spending and investment and so on, that seems to be losing a tiny bit of momentum as well. But I think it's also worth pointing out that it's still probably too early to be sure how this is going to pan out. The data is noisy, the tariffs have impacted spending patterns. We saw that in particular in a personal spending number that came out in May, a huge fall in motor vehicle sales in May, but we'd seen a huge increase in motor vehicle sales back in March. And indeed, the increase in March is almost exactly matched by the fall in May. And these are very significant numbers in the 50 billions at an annualised rate. So these huge swings make it a little bit tricky to make a judgment about what the underlying trend in the economy actually is. But as best we can judge, it does seem to be losing a little bit of momentum. Inflation pressures do seem to be losing a little bit of momentum as well. We haven't seen the tariff impacted increase that some had thought might occur. So the moons are moving in a direction for the US Fed to cut rates. The question now is whether it's as soon as the end of July or perhaps another couple of months further away.
And across the pond, you've got Europe that's in a slightly different position, particularly Germany. So the outlook's actually pretty strong there, and we've talked about that a little bit. It's, initially driven perhaps by defence spending, but it started to look pretty strong, isn't it, Rob?
Yeah, no, you're right. A couple of months ago, we had the German election earlier this year, and then we had a passage of an incredibly significant fiscal spending bill in the aftermath of that, although interestingly enough, passed by the Parliament as constituted before the election. The candidates that won in the election were actually in the Parliament. But anyway, that was passed. And this, as you say, is all about spending, mainly about spending in defence and infrastructure. And that has already had a significant impact on equity markets, on the nature of outperformance by particular sectors, so defence and infrastructure related. But it's also now broadly having an impact on sentiment. And we've seen now for a couple of months in a row that business sentiment in Germany has really started to pick up across a number of sectors. And that's really following the election and following the passing of the fiscal reform legislation. So it's hard to underestimate or underplay just how significant this reform actually is in the context of the German economy. And that will have flow-on effects across the rest of continental Europe. So that's been a real significant sort of watershed event this year.
Yeah, and a lot of European countries and the UK have committed to that increase in defence spending as well. So there'll be stimulatory effects there across Europe. Rob, let's now move to Australia. Employment seems okay. Inflation seems under control. The RBA, the Reserve Bank, didn't meet during the month, and you've talked about it being more than fully priced in that there'll be rate cuts. Can you unpack all that, please?
As you just said, employment here remains surprisingly, remarkably robust. The unemployment rate still just at a low level, 4.1. Employment growth over the last year or so is up almost 2.5%. And so that's stronger than the 10-year average that existed before the pandemic. That was around 1.7. So that's been incredibly strong. Hours worked are solidly up, a bit over 3% over the year. Although that's somewhat, as far as the RBA is concerned, in contrast to the story we're getting with the CPI. in the sense that we've now got these monthly measures of the CPI. They're moving in the right direction. The May number came out during the course of June, and the key number there is this so-called trim mean measure. That came in at 2.4% in May. That's the lowest annual rate since the end of 2021 and down significantly from April. So this particular measure strips out the 15% at either end of the price change spectrum. So the biggest increases, the 15% of the biggest increases, but also the 15% at the other end of the spectrum. So either the smallest increases or the largest declines in prices during the month. And that's the number the RBA looks at. And look, following that particular release, market pricing moved a little bit further, and now quite literally, the market's pricing a 27 basis point cut at the RBA meeting next week. Now, they don't move in 27 basis point increments, so the way we interpret that is a more than 100% probability that the RBA will cut next month. And look, as we've mentioned in regard to rate cuts earlier in the year, the RBA's really done nothing to disabuse the market, to talk to the market, to try and jawbone the market away from what is very clearly priced in. That being the case, it seems extremely likely as anything ever is in financial markets, that the RBA will move to cut rates for the third time this year next week, the second week of July.
So from an equity market perspective, therefore, the market is still comfortable with that. But the US was up really quite strongly in the month. The ASX really lagged a bit. I mean, it was still positive, wasn't it? As you say, up almost 1.5%, but it lagged the US, didn't it?
Yeah, no, it absolutely did. The US saw a rebound in all the tech-related stuff, IT tech-related stuff at the end of the month, and that really gave it a fillip towards the end of the month. And as we've discussed before, the local market doesn't have the exposure to those sorts of sectors. Look, we had yet another month where CBA hit another record high, closed the month up another 5%. It's now up 20% in the first 6 months of the calendar year. And given the fact that it's the largest stock in the market and it's continuing to rise at a pretty rapid pace, it just really continues to drive performance here in the Aussie market, much to the chagrin of many, many active managers who are scratching their heads and trying to understand the valuation that the market has put on this stock. It's really been that change in valuation, that PE ratio, or the price that investors pay per dollar of earnings, that has really been by far the overwhelming influence in driving the CBA price over more than a year now. It's been going on for quite some time. But as the stock gets larger and larger relative to the rest of the market and continues to rise at such solid levels, it really is the defining stock in our market, not unlike what Nvidia was doing in terms of contribution and importance in the market in the US, more so last year than this year. But it's continuing to confound many, many investors.
Yes, these things, they happen until they don't. And it's kind of a ridiculous statement to make, but it is confounding investors. And the simple fact is there's no one selling. That's neither retail nor wholesale, really, because wholesale, as you say, there are wholesale investors, institutional investors are generally probably underweight, so they can't afford to sell, and retail certainly isn't selling either. So it'll be interesting to see how long it goes on for. Santos also received a proposal during the month.
Yeah, so Santos received a so-called non-binding indicative proposal from a consortium led by XRG, that's a subsidiary of the Abu Dhabi National Oil Company, and Carlyle. Interestingly enough, they priced the offer in US dollars, which on the day of the offer was USD $5.76, which on the day equated to around $8.90. And as you can imagine, that offer drove the stock higher during the month. It closed about 16% higher at the end of June at $7.66.
Yes, and obviously there's a long way to go on that one, particularly as it's non-binding. So Rob, just in terms of the overall market then, where are we going from here? What's coming up in the next few weeks that's going to drive markets?
Let's start, as we usually do, with the US, because what happens in the US does drive what happens here. The equity market drives interest rates, certainly at the longer end of the curve, drives currency. So let's just start there. A couple of things coming up. First, labour force data on the first Thursday of the month. As we're recording this today, that'll be tomorrow night, because Independence Day is Friday, the 4th. So the market is very fixed on what happens with employment in the US. So that non-farm payroll report will be incredibly important. And then going into next week, it'll be the July 9 trade deadline. So as we mentioned earlier, there seem to be more positive signs in regard to potential deals with the Chinese, with the Europeans. But then again, as we're speaking now, there seem to be issues with the Japanese, and they're proving, I think Trump may have even said it there, much more difficult to come to an agreement with. But look, by and large, things seem to be moving in the direction such that a deal will be set with most countries. And where they're not, perhaps deadlines will be extended, and where there can't be agreement on that, perhaps a new tariff rate is set. But I think it's important to remember that wherever we end up in July, we won't be where we were before April the 2nd on Independence Day. We're going to have a higher tariff regime globally compared to where we were before all of this started. So in that context, the end of June sort of looked like the market pricing in a Goldilocks scenario. So increased expectations of a more dovish Fed, de-escalation of the Middle East tensions, progress in US trade negotiations, but all of this in the context of the fact that a number of these things could be quite tenuous. We've spoken several times today about the market ending in quite an optimistic tone, and I think we need to remember that. We did indeed end June with quite an optimistic tone to market trading.
Are there any risks to the market, do you think?
Well, they would be that, say, employment weakened very sharply. If we've got a negative employment number, that would be a big market mover. If we had a rebound in inflation, that would be a negative market mover. And of course, if we had a renewed deterioration in the Middle East, that would be a negative as well. And if we were to see that, in fact, the tariff uncertainty has more broadly slowed the economy and or it has brought about price increases, all of those, so in a sense, the flip side of all of the stuff that looked Goldilocks-like at the end of the month, if that all flipped, we would face quite a different sort of scenario. Here in Australia, the market's not cheap. There's the overwhelming influence of one stock, CBA. But the thing that is starting to unfold here, and we got an update on this just today, is that the consumer has not really bounced back since the RBA started cutting rates in Feb. We had retail sales out today, up just 0.2 for May. The annual rate of growth is slowing. It's now just a little bit over 3% year on year. And I think it's fair to say that if we want to use that hard data parlance here in Australia, the hard data on consumer consumption, household consumption, has really disappointed so far this year. So that adds to the argument for the RBA cutting rates, which seems, as we said, almost certain next week. But we really need to see some sign of a pickup, some sign of response from a spending point of view, because that's really what the market is expecting, that we will get a bounce back, that confidence will increase. I think probably for Australia, in the context of what's going on here, that is probably the biggest risk here, that we don't get this bounce back, that earnings estimates are disappointed on the back of that.
I mean, look, the vast majority of that, obviously, in terms of earnings, won't come through for a few weeks, but it'll be interesting to see. We'll have lots more to talk about, Rob, I suspect, at the end of July. Rob, thank you again for your time. That brings us to the end of today's podcast. We've looked at what happened in June 2025. We look at what it means for investors going forward. And the reality is that despite June being a surprisingly low volatile month, the expectation we have is that unpredictability and volatility is going to remain around for some time. We hope you enjoyed today's episode. Please subscribe so that you don't miss out on future podcasts. Follow us on LinkedIn, YouTube, Spotify, Apple, or wherever you get your podcasts from. And please do let us know if you have any questions or comments. Until next time, stay informed and stay active. This podcast is produced by SG Hiscock & Company. It does not constitute financial advice and assumes a certain level of knowledge. It's general information only and does not take into account the investment objectives, the financial situation or needs of any person and should not be considered a recommendation.